Hi, this is Brent Johnson with Santiago Capital. It is now July 2017, and while I would love to tell you that gold had either convincingly broken out to the upside or made a definitive bottom, unfortunately I cannot yet do that. The first few weeks of July have seen more volatility to the downside for gold, and it's currently at about the same place as our last update in late January. It tested resistance a couple of times this spring and early summer, but so far it hasn't meant to be, and it remains still in the middle of its 5-year channel. As you can see from this chart by Jordan Roy Byrne at the Daily Gold, if it turns out that the bear market is not yet over, it will go down as one of the longest gold bear markets on record, far exceeding those of the 1980s and late 1990s. But regardless, nothing has changed. All the arguments that existed when we first started Santiago are still very valid today. Some of them are even more compelling. Now, whether it's due to global debt levels, global derivative balances, zombie banks or bankrupt governments, or simply a small straw that eventually breaks the back of the market, the current trajectory of the global economy is simply not sustainable. And while a crisis is not necessarily imminent, it is all but inevitable. And I'm not going to go over all the reasons for owning gold again now. You've heard them a million times. And ultimately, they all boil down to this one. The global monetary system has a design flaw, and it will eventually lead to its destruction. And while nothing is 100% certain, math and history are two pretty good partners to have on your side. And the math of the global economy says it's not sustainable. So if you believe in math, hold on to your gold. Just put it away and don't look at it. It will be there when you need it. In the meantime, the S&P 500 remains well above its long-term support and continues its grind higher, to the shock and dismay of many equity bears. And so far, the 40-year bull run in the 10-year U.S. Treasury continues to roll on as yields continue to remain low. And the Volatility Index is sitting at its all-time low. But this may actually be a short-term positive for gold, because the dog days of summer usually provide at least a little excitement, and it wouldn't surprise me at all to see a spike in volatility in the very near future. And as something that typically benefits from volatility, this may prove a catalyst for gold. And this could be very important because while gold remains inside its bearish channel, long-term support is rising quickly. And the long-term wedge that has been trading in for several years is due to converge in the coming months. Another positive short-term catalyst is the positioning of the commercial futures traders. Often equated with the smart money, they have reduced their large short positions in a massive way. And while it's not yet back to historical lows, those levels are fast approaching. And this has historically been seen as a fantastic setup for gold to move higher. We also have the German elections coming up in September. It is well within reason to see gold catch a bid due to some potential short-term euro strength or political uncertainty surrounding this event. And finally, another short-term catalyst for higher gold prices in the short term is the impending debt ceiling debate coming up in the U.S. Congress. To be clear, there's no question that the debt ceiling is going to be raised, but the political theater and debates surrounding it will no doubt make for a few volatile headlines along the way. The real question in my mind is whether the short-term pop in gold is going to be enough to break through the resistance and remain above this resistance level. And so what would be the one thing that I would worry about in the short term that could keep this from happening? Well, it's dollar strength. I've gone on record several times as saying I think the dollar is going to go much higher before it's all said and done. And while ultimately this is going to be very good for gold, in the short term, a rising dollar could be a headwind. Now, so far, I've been dead wrong on the dollar this year. The dollar topped in early January, and it's now back below short-term support and long-term resistance. The dollar has now fallen over 7% year to date and has gone from one of the most loved assets of the year to one of the most hated. And this is somewhat concerning because while gold had a very nice pop at the beginning of the year, it has sold off along with the dollar into the summer. If gold cannot rally with a falling dollar, it may prove to be even more difficult to do it if the dollar catches a short-term bid. But why do I continue to defend the dollar when it continues to fall? And besides, aren't gold guys supposed to hate the dollar and proclaim its demise? Well, as I laid out in my presentation from last year called Step Into Liquid, I see 6 different major waves, each with the potential to send the dollar much, much higher all on their own, let alone if they happen concurrently. And I have seen nothing yet to tell me that any of these waves have been completely taken off the table. Additionally, I have my friends Paul Milcreast at ADMSI and Darth at the Old School Macro blog for pointing out to me that part of the reason the dollar fell off in the spring was because the U.S. Treasury drew down their cash balance at the Fed by $400 billion. They did this due to the inability of issuing more short-term bonds due to the debt ceiling encroachment. Come the fall, not only will the Treasury not be drawing down this balance, but rather than the debt ceiling being behind them, they will be issuing new bonds, draining the market of excess dollar liquidity and potentially crowding out corporate rates at the short end of the curve. This should push rates higher, drawing more strength to the dollar. I followed up the Step into Liquid presentation with Don Yuan at the earlier part of this year, as the competing forces of inflation and deflation continue to battle it out. Here, I took a look at the major world currencies and the fact that the Fed has taken a major divergence from their central bank counterparts in the rest of the world. The Fed continues to raise, and talk of unwinding their balance sheet continues to be in their playbook. I think this divergence will lead to increased capital flows from around the world back into the U.S., as the U.S. will be seen as one of the cleanest dirty shirts amongst all the world where central banks continue to provide unprecedented support. This will become a vicious circle, drawing even more capital flow into the U.S., and I believe it will lead to either a currency crisis or sovereign bond crisis abroad. And if anyone doesn't think that this flow of funds back to the U.S. can happen, maybe they can help me understand why roughly half of the bank cash balances at the Fed are already owned by foreign banks. As a result, I continue to think it's the strong dollar that will bring down the monetary system, not a weak dollar. Long story short, I do not think the world has decoupled by any means, and if the U.S. does go back into recession, I believe that we will take the rest of the world with us. And as a result, dollars and gold will rise together and be the last men standing together before the world demands a reset takes place, dethroning the dollar from the world reserve currency once and for all. Now, I know there are a lot of people out there who disagree with me on this, and that's okay. Some may think that we're already moving towards a de-dollarized world. Others think there is no reason to own gold if the dollar is going to rally. Others think that the U.S. is not the cleanest dirty shirt and the world has decoupled economically, and that the emerging markets will rise as the dollar continues to weaken along with the rest of the U.S. economy. So what I'd like to do now is a little experiment. But first, a small apology. It turns out that this presentation is going to be much longer than I originally anticipated. I tried to cut it down, but I think the material is important, and just working on it helped me see things more clearly. But due to its length, I realize you may have to set it down and come back to it from time to time. So feel free to do that, and I apologize if we go on too long. Now, for the rest of the presentation, I'm going to ask you to do something very hard, which is just listen and just think. I say this is going to be hard because it's my experience that most people listen with the intention of replying, rather than listening with the intention of thinking about what's being said. I'm also going to ask you to keep an open mind. If you can do that, I think you'll enjoy it. But if you can't, and your mind is already made up regarding how you see the markets or trades that you currently have on, you should probably just stop watching now and save yourself the time. Finally, I think it will be hard because while you may agree with some of what I say from time to time, I'm absolutely sure I'm going to say something along the way that you're going to vehemently disagree with. And you're not just going to think that I'm wrong, you're going to be absolutely certain that I am wrong with every fiber of your being. And you are going to want to scream and yell about how wrong I am. Which brings me to one of my favorite investors uttering one of my favorite lines of all time. During the height of the European sovereign crisis, after listening to economist Jeffrey Sachs drone on about how everything was going to be okay, despite his outrage, Hugh Hendry calmly said, "I recommend that you panic." Now, I'm hoping my ideas don't cause any outrage or any panic, but if they do, I hope we can discuss it calmly like Hugh here. Because I think people are literally losing their minds. Whether it's people on the left who just cannot handle the fact that Trump is in the White House, or the people on the right who cannot believe that CNN is still in business. Whether it's the gold bugs who insist the yellow metal should already be trading above $10,000 per ounce, or the equity bears who think the S&P 500 is overvalued by at least 50%. The fact that their minds are saying one thing while simultaneously trying to comprehend the realities that their TVs and computer monitors are streaming forth, the cognitive dissonance is absolutely driving them crazy. And my guess is that many of you, and probably even myself, are suffering from holding two competing thoughts at once. So since we're now getting into the psychological side of capital markets, I'm going to refer to a few of my favorite movies involving psychos, namely Martin McDonagh's Seven Psychopaths, the Hitchcock classic Psycho, and Christopher Nolan's The Dark Knight. I'm also going to draw upon three books that I found fascinating and highly recommend that you read. Robert Burton's On Being Certain, Kevin Dutton's The Wisdom of Psychopaths, and David Eagleman's Incognito. Now, early on in the McDonough's film, Marty, the main character, explained to his friend Billy that he's writing a movie about psychopaths. And he says, "Yeah, I'm sick of all these stereotypical Hollywood murderer scumbag type psychopath movies. I don't want it to be one more film about guys with guns in their hands. I want it, overall, to be about love and peace. But it still has to be about these 7 psychopaths." And that's how I want the rest of this presentation to be. Overall, I want it to be about keeping our heads during this crazy game that we're all playing. I want it to be about friendship and communication and understanding. But don't get me wrong, we're going to be talking about some real psychopaths along the way. After all, the reason this is such a good topic is because society as a whole has a fascination with psychopaths. Some common traits include persuasiveness, charm, manipulation of others, lack of remorse, and a grandiose sense of self-worth. And whether they are those put forth by Hollywood or the people we see in real life, they always seem to draw us in. Perhaps our fascination is nothing more than the fact that, as Winston Churchill once proclaimed, great and good are seldom the same man. Even Aristotle once proclaimed, there was never a genius without a tincture of madness. Kevin Dutton theorizes that one of the reasons we are fascinated is because we love illusions, by things that appear on the surface to be normal, yet upon closer inspection turn out to be anything but. For example, take a look at the soccer balls in this picture. How many soccer balls do you see? Are you sure? Take a closer look. Well, if you said 6, congratulations, you're correct. But while you were looking at the soccer balls, did you notice that the guy has 6 fingers on each hand? This is kind of what psychopaths are like. Nothing seems amiss. They're not technically hiding anything, but they use their psychological camouflage to distract us from the blatant truth that's right in front of our eyes. Dutton also conducted the first of its kind survey in the United Kingdom, which assessed the prevalence of psychopathic traits within an entire national workforce. It turns out that some of the most highly successful people throughout society share many of the similar characteristics with psychopaths. Although there is one profession I think that is a dead ringer that somehow got left off this list. And that brings us back to the 7 psychopaths. Or perhaps we should simply call them the 7 voting members of the FOMC. Brainerd, Powell, Evans, Kashkari, Yellen, Kaplan, and Fisher. Their leader, who has never even held a job outside of government or academia, even has the audacity to make the psychopathic claims that there will never be another financial crisis in our lifetimes. I mean, despite their outward appearance, these are some seriously scary people. In fact, I think you'd be hard-pressed to come up with another group who have done more harm to more people than anyone else in the world. These psychopaths actually believe they are smarter than the collective wisdom of a marketplace made up of billions of people. The hubris is quite staggering. Some of the byproducts of this group include profligate government spending, exponential growth of debt, invisible theft of savings, misallocation of assets, social inequality, financial inequality, and moral hazard. And yet, I challenge you to find even a hint of responsibility or remorse from this crew. They kind of remind me of John Wayne Gacy, who during his trial for murder said, "All I'm really guilty of is running a cemetery without a license." Now, back in 1972, Alan Harrington put forth a radical new theory on human evolution. He said that psychopaths constituted a dangerous new breed of human, a psychological superhero free from the shackles of anxiety and remorse. Now, I certainly don't think of central bankers as an evolved species, but I do put them at the top of the financial food chain. And this is why I think we have to be very careful when Fed critics start referring to them as morons, buffoons, or idiots. These guys have been hiding in plain sight for years. Not only that, they've convinced the larger part of society that they're their friends. And as such, I think they are the source of much of the cognitive dissonance running rampant today. Many people in the capital markets are so worried about the central bankers failing that that's all they can think about. And it's a legitimate concern. The central bankers are nowhere as smart as they think they are. But the problem I see is that many people are so certain the central bankers are going to fail, they fail to stop and think about the consequences of these psychopaths actually succeeding. And this is where the Joker from The Dark Knight comes in. In one of his most revealing scenes, he says, "You know what I noticed? Nobody panics when things go according to plan. even when the plan is horrifying. If tomorrow I told the press that like a gangbanger would get shot or a truckload of soldiers would be blown up, nobody panics because it's all part of the plan. But when I say that one little old mayor will die, well, then everybody loses their minds. Now think about that with relation to our 7 psychopaths. Years ago, they set to work manipulating the bond market. They did this because the bond market sets the interest rates, and interest rates are nothing more than the price of money. The reason they want the price of money lower is the knock-on effects. Specifically, the rise in asset prices such as the equity market and the real estate market. And as a result, we've seen a huge real estate boom in places like New York, Toronto, and Sydney. We've also seen stock markets rise for almost 8 years straight. And as a result, these have become some of the most hated bull markets in history, as many just cannot understand how the prices just keep going up. And the interesting thing is I don't think it's hard to be bearish these days. You are no longer laughed at if you say the markets may fall. And as such, many are sounding the alarm, warning that this is indeed what's going to happen. And I don't necessarily have a problem with this prudence. Equity markets are deep into one of the largest expansions in history, and prices are indeed stretched. But I find it very interesting that people are more concerned with the symptom of the problem rather than the problem itself. I thought Simon Mikhailovich put it very well when he said, "By breaking the pricing mechanism, central banks unleashed financial cynicism. Investors can see the price of everything without any idea of its value." As a result, I bet the Joker is looking down at us and laughing, because people are mostly concerned about the central bank's plan failing, rather than worrying about the plan succeeding. Because the bond market is where all the abuse is taking place. The bond market is the problem. The bond market is their plan. And the bond market is much bigger and much more important than the stock market or real estate market. And as of right now, the 7 psychopaths are hell-bent on getting rates higher. But I know what you're thinking. In fact, I know what you're almost certain of, because at one point I was certain of it myself. They can't do it, right? And this is where the cognitive dissonance of the Fed critic gets really bad. It's so bad, in fact, that it branches off into 2 separate arguments, which is arguing with yourself about what you really believe in, manipulation of interest rates or no manipulation of interest rates, as well as arguing with yourself with regard to whether the Fed can or cannot raise rates without causing a recession. If you didn't like the Fed holding rates down all those years, then you shouldn't have a problem with letting rates rise now. Without the Fed, rates would be much higher. So if you believe in the free market, you shouldn't have a problem with higher rates. If you do have a problem with higher rates, then you are in favor with manipulation, just so long as it's manipulated as you see fit. The other side of the anguish is, how can the Fed raise rates? For a long time I heard, and probably even said, that they would never ever be able to raise rates without crashing the stock market. But 18 months and 4 rate hikes later, markets are at all-time highs. And now it seems to me that the general consensus is that the Fed will not be able to continue raising or normalize their balance sheet at the pace that they have hinted. The bond market certainly isn't buying it at this point. And there may be many out there who are just absolutely certain that interest rates cannot rise because it will cause a recession. First off, I would argue that a recession is not a problem, but a symptom. And even then, the symptom is not bad, but rather a necessary thing. But what I want to focus on is the certainty that I know many people have in the belief that interest rates cannot be allowed to rise. Because in the capital markets, I don't know anything that's more dangerous than certainty. Robert Burton, an American neurologist, wrote a fascinating book called On Being Certain, which I highly recommend. His basic question that he tries to answer is, what does it mean to be convinced? Seems simple. You study the evidence, look at the different facts of the case, and you come to a decision, right? Well, it's not that simple, and in fact, modern biology is saying otherwise. In fact, studies show that despite how certainty feels, it is neither a conscious choice nor even a thought process. Certainty and similar states of knowing what we know arise out of an involuntary brain mechanism that, like love or anger, functions independently of reason. He goes on to say that the feeling of knowing, the reward for both proven and unproven thoughts, is learning's best friend and mental flexibility's worst enemy. So let's stay here for a minute on the idea that interest rates rising will throw us back into a recession. How do we know? Why are we so certain? Is it the result of much study of the facts and as a result correct? Or as Burton suggested, did our feeling of knowing come involuntarily and independent of reason? Are we really seeing things clearly? In Incognito, David Eagleman says that it's very hard to be completely objective regarding what we see, because as strange as it sounds, our expectations influence what we see. There has to be a match between your expectations and the incoming data for you to see anything. As an example, take a look at this picture. If your brain doesn't have a prior expectation about what the blobs mean, you simply see blobs. There has to be a match between your expectations and the incoming data for you to see it. In other words, vision has to be predicted. It has to be learned. But if I give you just a hint, this allows the image to take on a new meaning as a bearded figure. But without the hint or expectation, the light patterns hitting your eyes are generally insufficient for vision to occur. But once you have the hint or expectation, you can see the figure every time, even when the hint is no longer there. This is not a recent discovery. 150 years ago, Hermann von Helmholtz, a legend in medicine, physics, and psychology, concluded that the brain must make assumptions about incoming data, and that these assumptions are based on our previous experience. In other words, given a little information, our brain uses its best guess to turn it into something larger. And this is partly why one of the most important maxims for a fighter pilot is trust your instruments, because your senses will tell you the most inglorious lies, and if you believe them instead of your instruments, you'll crash. So going back to interest rates, if we've been in a 40-year bull market for bond where interest rates did nothing but fall, and we don't have any expectations for that changing, and if we don't have any experience with it, even if we did have the expectation, would we even be able to see it, even if it was right in front of us? There are now guys and girls heading fixed income trading desks who have never known anything but QE. There are guys and girls who have had very successful 30-year fixed income careers who have never seen interest rates rise for more than a quarter or two before heading back lower. Do we honestly think this is normal? Do you really think it's impossible for this to revert? Heck, interest rates are at 5,000-year lows. Is it really so hard to believe that they might rise, regardless of what the psychopathic central bankers do or don't want? I was in a meeting recently with about 20 different hedge fund managers, pension fund managers, family offices, and private investors. And there were a couple of presentations showing how rates were due to stay low for years to come. And they were very well done, extremely convincing. And it may very well end up being correct. In fact, the only problem I had with them was when I looked around the room, everyone was nodding in agreement. I even asked if anyone disagreed, and no one did. And that immediately set off alarm bells in my head. Okay, so how and why are interest rates going to rise? Well, number one, I'm not sure that they're going to. But what I do know is it's not a zero probability event. And I think the probability that they could rise much faster and much further than the currently priced into the market is actually fairly high. But before we dig into this and how this might happen, let's go back to another area of cognitive dissonance that I run to a lot in the gold world. Let's go back to the US equity market and the dollar. It's pretty common in the gold world to come across those preaching a doomsday scenario, and perhaps rightly so. After all, that is one of the main arguments for owning gold in the first place, and I myself think we're in for a period of very high volatility and despair. But the one I really have to scratch my head is when I'm told that the stock market's going to crash and the dollar is going to crash along with it. Now again, I don't have a problem per se with either stocks crashing or the dollar crashing, but not together. If the dollar is going to zero, the last thing you want to do is sell your stocks, because that is one of the few places that can help protect you against a rapidly depreciating currency. If the dollar goes to zero, you won't be able to spend it quick enough to retain any value. Better to spend it on some stocks and set them next to your gold, and you might just have a fighting chance. If you doubt this, just go back and look at the stock market returns of any country that is ever hyperinflated. They often lead the world in returns. And as a follow-on to this, it's my experience that even the dollar bearers will admit that if we have some type of crisis or volatile risk-off event, the dollar may experience a spike in the short term before eventually turning back down. But that's the whole point. There is going to be a crisis, and I think the dollar is going to trade higher as a result. And while the world is moving towards a de-dollarized system, it's not there yet. And until it is, when this crisis comes, the dollar is going to be one of the few places to catch a bid. Maybe it's just for a few weeks or a few months, but the pain it will cause the rest of the world, and cause the rest of the world will be enormous. But now let's just go back to equities alone. And let's talk about the fact, let's talk about the fact that it seems like every day somebody new throws in the towel and tries to call the top, and that it is only downhill from here. They cite these 8-year uninterrupted returns. They will show that earnings in the last 3 years have gone nowhere, while prices have continued to rise. And as a result, price to earnings ratios are well above the long-term average. They will also show how stock prices as a percent of household net worth have only ever been this high in 1999 and 2008, right before the last 2 equity crashes. Again, I don't have a problem with this in a vacuum. They're right, equity valuations are high, and it is well within reason to be concerned and take some precautions. But I think the symptoms are being overly focused on to the exclusion of the real problem and the real beating that's taking place, which is in the bond market. Can you honestly say that bonds are not overvalued as well? Is it not possible for the bond market to break, and in fact break first? I mean, you want to talk about an extended run. The 40-year bull market in the 10-year U.S. Treasury continues to roll on as yields continue to remain very low. If I flip this chart around and show you the inverse, doesn't this seem to be a little long in the tooth? And can you explain to me on the capital asset pricing model why the risk-free rate is a higher rate than many of its counterparts around the world? And while you're telling me about the historical high valuation in equities, can you please show me where in history we've had valuations in bonds that were so high that the market was pricing $10 trillion worth of negative yielding sovereigns? And while you're at it, can you show me any place or any time in history where a government actually ever paid off its debt? Argentina, it seems, is perpetually in default. Yet last year, they issued $15 billion of debt, only to follow that up with a 100-year bond issued last month. I mean, seriously? The point I'm trying to make is that the central banks are the bond market, and that's where the real danger lies. It doesn't mean that bond valuations can't go higher and stay there longer. And I know it's hard to see the risks, even when they are right in front of you. But this is why I think that while equities are certainly due for a correction, I don't think they're in for a crash. In fact, I think they may go much, much higher. Not because things are so good, but because they are so bad. If people wake up and realize what the psychopathic central bankers have done is to create a bubble in the public markets that is much, much bigger than the bubble in the private markets, it could get really crazy. Global credit markets are over $200 trillion, much, much bigger than the equity market. And there is no organic global economic growth. The little growth that we do have is being fueled by even more debt and more credit. And as a result, this global credit pool is eventually going to break. And whether it starts in the currency market or the sovereign bond market, I think that time is coming sooner rather than later. And if this happens before the equity correction, the money that flows out of bonds will be looking for a home. And the only market that is even remotely large enough to handle those types of flows is the equity market. Think about it. If Italy cannot pay their bills, is a family office in Milan more likely to buy an Italian bond backed by a doomed EU or a rapidly depreciating lira? Or would they rather own Philip Morris International yielding 3.5% in the world reserve currency? This chart from Jawad Mian at Stray Reflections does a great job of showing how quickly things can go south in bond land due to a rise in rates. If people start to lose money in a trade that has worked for 40 years, do you think they're just going to stand by and let it happen? Do you think new money is going to come in and buy the falling knife? I don't think so. Or I think it's just as likely that they'll stay away from these prices as they would stay away if the stock market was crashing. In any case, if the rate rise comes to pass, it could lead to panic in bond land. But maybe you don't think that's possible. Maybe that's not a good reason why interest rates could rise. But maybe there's another way they could rise. The G20 think themselves pretty clever. and are constantly trying to come up with new ways to spur economic growth. And in a couple of years, their summit is scheduled to be held in Tokyo. What better place for them to announce the cancellation and forgiveness of all G20 debt sitting on all G20 central bank balance sheets? Who would argue? Debt to GDP ratios would immediately improve. Balance sheets would be restored. And at the Milken conference last year, the ratings agency Fitch indicated that they may very well even upgrade Japan's credit rating should this happen. If any of these scenarios should come to pass, the equity markets may just be getting started. Again, not because things are so great, but because they're so bad. Now, I know what many of you are thinking. No way in hell does this happen. It's just not possible. But are you sure? Are you absolutely certain? And if you are certain, is this the result of much vigorous contemplation of the facts? Or, as laid out by Dr. Burton, is your certainty an involuntary brain mechanism that, like love or anger, functions independently of reason? In The Crack-Up, F. Scott Fitzgerald wrote that the test of a first-rate intelligence is the ability to hold two opposed ideas in the mind at the same time and still retain the ability to function. Well, if that's not possible, and you had to choose, would you rather be informed or would you rather remain sane? Finally, I think I'll wrap up this presentation in the same way that Burton wrapped up his wonderful book. It's a quote from David Goss, the 2004 Nobel Prize winner in physics. He said, "The most important products of knowledge is ignorance." Couldn't have said it better myself. In any event, I hope I've spurred you on to do some thinking. I encourage you to challenge your own assumptions, come to your own conclusions, and feel free to challenge mine. I don't claim to have all the answers, and I'm certainly not trying to cause any harm. After all, I wouldn't even harm a fly.